Imagine a company that's profitable, debt is manageable, cash is piling up, and returns on capital are the envy of most of the retail industry. And yet its stock has been cut nearly in half over the past year. That's not a hypothetical. That's Lululemon Athletica, ticker Lulu, right now. And the strange part is, the deeper you dig into the numbers, the more confusing the story gets. So let's dig in together. First, the size of this business. Lululemon carries a market cap of $13.28 billion, meaning that's roughly what the entire company is worth on the stock market today. When you add in its debt and subtract its cash, you get what's called enterprise value, which sits at $14.11 billion. Think of enterprise value as what it would actually cost someone to buy the whole company. Debts and all, not a small business by any means. But here's where things get interesting. Over the last 52 weeks, the stock price has dropped by 48.21%. That's not a dip, that's nearly cutting the price in half. Now, when a stock falls that hard, you'd expect the business itself to be falling apart too, right? But that's not what the numbers show. In the last 12 months, Lululemon brought in $11.20 billion in revenue and kept $1.46 billion of that as pure profit. Its earnings per share, meaning the profit divided across every share of stock, came out to $12.40. That's a substantial number for a company whose stock has been sinking. And this is where investors often get confused. Because of that price crash, the trailing price to earnings ratio, or PE ratio, which tells you how much you're paying for each dollar of profit, is sitting at just 9.58. To put that in perspective, a PE under 10 often signals a stock that the market is pricing quite cheaply relative to its earnings. So why would a profitable, cash-generating business be trading like this? Let's look at how efficiently this company actually runs. The gross margin, meaning how much money is left after covering the direct cost of making the product, is 55.70%. After all operating expenses, the operating margin is still a healthy 18.29%. And when you look at return on equity, which measures how well a company turns shareholder money into profit, Lululemon posts an impressive 32.03%. Return on invested capital, a similar but broader measure of efficiency, comes in at 27.72%. These are not the numbers of a struggling business. At first glance, that sounds impressive, but the stock price is telling a completely different story. So let's check the balance sheet, because that's usually where hidden risks show up. The company holds $1.51 billion in cash, but carries $2.14 billion in debt, putting it in a net debt position of about $621.28 million. Now, before you panic, the current ratio, which measures whether a company can cover its short-term bills with short-term assets, is 2, meaning it has more than double what it needs to cover near-term obligations. And its Altman Z-score, a formula designed to flag bankruptcy risk, sits at 6.95. Anything above 3 is generally considered a safe zone, so this company is nowhere close to financial distress. And that's not even the most surprising part. Instead of paying a dividend, Lululemon has been buying back its own shares, reducing the total share count by 3.94% over the past year. This is reflected in what's called a buyback yield of 3.94%, meaning management is essentially returning cash to shareholders by shrinking the number of shares outstanding rather than issuing checks. Free cash flow, the actual spendable cash left after running and investing in the business, came in at $1.28 billion for the year. So with strong margins, high returns on capital, manageable debt, and a company actively buying back its own stock, why has the price fallen so far? Here's one number that changes the picture. Wall Street analysts are forecasting earnings per share to actually decline by 2.76% over the next 3 years, even though revenue is expected to grow slightly by 2.50%. That's a contradiction worth sitting with. Sales inching up, but profits per share expected to shrink. On top of that, short interest, meaning the percentage of shares that traders have bet against, sits at 8.67% of shares outstanding. That's a meaningful number of investors positioned for the stock to fall further, not rise. Meanwhile, the analyst consensus rating is listed simply as hold, with an average price target of $127.92, about 9.37% above where the stock sits today. Not a bold call in either direction. There's also the Piotrowski F-score, a 9-point checklist used to measure a company's financial health across profitability, leverage, and efficiency. Lululemon scores a 4 out of 9, a middle-of-the-road result that doesn't strongly confirm improving or declining fundamentals. So here's where we land. On one side, you have a company with strong margins, high returns on capital, low bankruptcy risk, and a management team actively buying back shares. On the other side, you have a stock that's fallen nearly 50% in a year, earnings expected to shrink over the next 3 years, and a meaningful number of investors betting against it. Two very different stories, both built from the same set of numbers. So the real question is this: has the market overreacted to something temporary, or does it see a slowdown coming that the current numbers haven't caught up to yet?